Investing can seem complicated, especially if you're just getting started. You might wonder, where do I even begin? What assets should I invest in? How do I balance risk and reward? This video aims to answer those questions by breaking down investing step by step, explaining every major asset type in simple terms. Whether you want to grow your savings, plan for retirement, or just understand the basics, this guide will help you make informed decisions without jargon or confusion. Let's start by looking at the first essential concept in investing: understanding assets and how they work. NTHE foundation of investing is understanding what assets are. An asset is anything you can own that has value and can potentially grow over time. Common assets include stocks, bonds, real estate, and cash, or cash equivalents. Each asset type behaves differently in terms of risk and return. For example, imagine you have $1,000 to invest. You could buy shares in a company, which means owning a small part of that business. If the company grows and earns profits, the value of your shares might increase, and you might receive dividends. On the other hand, you could lend that $1,000 to a government or company by buying bonds. Bonds typically pay regular interest, but generally offer lower returns than stocks and come with lower risk. This simple example shows how different assets offer different paths to growing your money. And once you understand assets, the next key idea is diversification. Diversification means spreading your investments across different asset types, industries, or regions to reduce risk. Instead of putting all your money into one stock or one type of asset, diversification helps protect your portfolio if one investment performs poorly. For example, if you invest only in tech stocks and the tech sector faces a downturn, your entire portfolio could lose significant value. By diversifying, you might hold a mix of stocks from various industries, bonds, and perhaps some real estate investments. The main advantage of diversification is risk reduction. It smooths out volatility and can improve long-term returns. However, the downside is that diversification can also limit the upside potential because the best performing assets might be balanced out by others that don't do as well. So, while it reduces risk, it may also moderate gains. NNTO illustrate how asset choice and diversification play out in real life. Let's consider two fictional investors, Sarah and James. Sarah decides to invest all her money into a few high-growth tech stocks because she believes they will offer the highest returns. James, on the other hand, chooses a diversified portfolio, investing in a mix of stocks from different sectors, bonds, and some real estate funds. Over a period of 5 years, Sarah's concentrated portfolio experiences large ups and downs. When tech stocks perform well, her portfolio grows quickly, but when the sector faces challenges, her investments take a significant hit. James's diversified portfolio grows steadily, without sharp declines, providing more stability. While Sarah's approach might yield higher gains in good years, James's method reduces risk and helps protect against severe losses, highlighting how different strategies suit different risk tolerances and goals. Sarah and James. Sarah decides to invest all her money into a few high-growth tech stocks because she believes they will offer the highest returns. James, on the other hand, chooses a diversified portfolio, investing in a mix of stocks from different sectors, bonds, and some real estate funds. Over a period of 5 years, Sarah's concentrated portfolio experiences large ups and downs. When tech stocks perform well, her portfolio grows quickly, but when the sector faces challenges, her investments take a significant hit. James's diversified portfolio grows steadily, without sharp declines, providing more stability. While Sarah's approach might yield higher gains in good years, James's method reduces risk and helps protect against severe losses, highlighting how different strategies suit different risk tolerances and goals. Research supports the benefits of diversification. A well-known study by Nobel Prize-winning economist Harry Markowitz, called Modern Portfolio Theory, shows that combining assets with different risk and return profiles can improve overall portfolio performance. For example, data from the S&P 500 index over the past several decades shows that stocks generally offer higher returns than bonds, but come with more volatility. Bonds, conversely, tend to be more stable but with lower returns. When combined in a portfolio, the overall risk decreases without sacrificing much potential gain. This principle is why many financial advisors recommend a diversified portfolio tailored to your risk tolerance and investment timeline. Real-world data confirms that diversification isn't just a theory, it's a practical strategy to help investors manage risk and achieve smoother growth. To summarize, the most important points for beginner investors are first to understand what different assets are: stocks, bonds, real estate, and cash, and how they behave in terms of risk and return. Second, diversification is a critical strategy that spreads risk by investing across multiple asset types, helping to smooth out volatility while potentially improving long-term results. Keep in mind, however, that diversification also means you may give up some upside potential in exchange for greater stability. Your investment choices should reflect your personal financial goals, risk tolerance, and timeline. Starting with a diversified portfolio suited to your comfort level is often the safest path, especially for beginners. Remember, investing is a long-term process, and staying informed and patient can make a big difference over time.